So I want to talk about an area that, I've had extreme skepticism about, over the past, handful of years. And I've gotten a lot of questions from clients why I'm so skeptical about the asset class. The asset class that I believe is the largest concern when it comes to financial markets is private markets, specifically private equity and private credit. And I've had concerns about this space for years now. Um, and like I said, I've gotten a lot of questions and a lot of pushback from people in the industry, but just more so questions as to, okay, well, you have large institutions pushing, private credit or private equity, or, going back a couple of years ago, it was pretty much deemed that any client, especially high net worth client, needs access, or excuse me, needs exposure to private credit because of what they call non-correlation to public stocks and public bonds. And what non-correlation means is that it's not correlated to public stocks or public bonds, meaning that, okay, it doesn't perform the same way. So if public stocks are down in a significant amount or public bonds are down a significant amount, doesn't necessarily mean that, private stocks and private bonds are down. Um, Case in point, going back to 2022, where, we had a pretty decent bear market and, pretty much every public equity market around the world was down probably somewhere around 20%, 15, 20%. S&P was down right around there. And, actually the bond market had its worst year in history over a century. It was down, roughly like 10%, depending on what bonds we're talking about. There's basically nowhere to hide that year. Um, but surprisingly, private equity and private credit, and also private credit just means private bonds, um, held up substantially well. At least they did on the surface. I think the private equity index was down only like 4% that year, which, if you're looking at the numbers, it, you know, um, sells their case in terms of the non-correlation, where, you have equities or public equities for this conversation down 20% pretty much everywhere over the world. And, in private equities down only 4%. That sounds great. And performance over the last decade has been fantastic. In the space. Um, but going back to my concerns about the space, you need to start from a mechanical standpoint and how the asset class operates. And what I mean by that is, so how private equity or private credit gets their funding, right? It's no different than a mutual fund company or any investment manager in the public space, right? So they'll take investors' money, they invest capital that they get from investors, right? How that works from our perspective, you know, you you basically make commitments ahead of time. So let's just say you want to put $250,000 into a private equity fund. What'll happen is you'll commit $250,000. You'll put it in a separate account, and then they'll have what are called capital calls, right? Because private equity is it moves at a much more glacial pace, if you will. The process is a lot slower relative to public equity, right? So when I say public equity, it's just like, shares of Tesla, Nvidia, Apple. You can go and buy a share of any public stock at the click of a button, right? Whether you have an advisor or whether you do it on your own, it's instantaneous. Well, private markets are much different, because again, they're extremely illiquid. When I say illiquid, you can't sell at the click of a button, just like you can with public stocks. And it takes some time to find companies that they want to buy or that they can buy. So going back to the capital call structure, what they'll do is, okay, say you commit, $250,000, they'll draw down from that $250,000. So let's say they'll find a company, and you have, like I said, the $250,000 invested in XYZ Fund One. They'll make a capital call basically from that 250,000, let's say of 50,000. So now you have $200,000 left that they can then draw down from. So, they get enough capital for XYZ Fund 1, and then they'll move on to XYZ Fund 2. Then they'll draw down on the $200,000 you have remaining, and so on and so forth until the $200,000 is fully invested. That's not an issue, right? That makes complete sense, right? And actually, it seems like they're doing their due diligence, they're taking their time, um, and certainly, maybe they are, or maybe they're just waiting for companies to come on the market. But the the real issue is real, in my opinion, is how they price assets, especially right now, and the lack of transparency that there is when it comes to pricing the assets that these companies have on their books. So going back to, first of all, I should say this: private equity and private credit space, the asset class, just those two alone, is somewhere between like 11 to $14 trillion. So it's massive. I think the majority of that is private equity. I think the breakdown is, somewhere around like 8 to 10 trillion of that is private equity. The remaining is private credit. And how they've ballooned so much, or no, not necessarily balloon, but just grown so much in size over the last decade or two is, going back to the global financial crisis in 08, 09, heavy regulations came down after that happened on traditional banks. And then there was still a subset of the market or companies that still needed, capital for funding. And that's where private equity and private credit came in. The industry is, a lot less regulated, which for me, not necessarily is a concern, right? I'm not I'm not a big proponent on red tape. I think it slows down efficiency, most times. So, the lack of regulation, it's a lot easier to navigate and maybe give some loans to people or to companies that traditional banks aren't allowed to. Doesn't necessarily mean they're inherently more risky. Maybe sometimes, but large institutions can make riskier investments as well. But that's just kind of how the asset class has ballooned from whatever it was back then. I don't know, 10 $100 billion, somewhere around there. Don't quote me on that number, but to where it is today. And going back to how they price assets, if going back to like the public side of things, where most of us have our money, where public equities or public bonds. Let's just focus on public equities throughout this because it's easier to understand. Not many people buy their own individual bonds, but like I said, if you have a share of Apple, or you want to go buy a share of Apple, it's a click of a button, instantaneous. You have the share of stock in your brokerage account. And then if you want to sell it the next day, you can do the same thing. Click of a button, you get whatever the price is that day, and you get your money back. It's extremely liquid, right? So that's what I mean by liquidity. Well, when it comes to private equity and private credit, right, it's very different. Like I was saying before, it's extremely illiquid. There's only a certain number of buyers. You or I can't go out and just invest in a public or private equity company, and I can explain why later on or in a little bit here. So you need managers to do that for you. There's no other way to do that right now. So by the time they fill up funds and get capital from clients, and they slowly start to invest, right? The idea is that very infrequently are they going to sell those assets. Or at least that's the idea of it, right? Where, okay, they'll go out, they'll come up with a strategy, and each fund has a window of when you're supposed to get your money back. So let's just say a lot of them are 5 years. So you'll commit, the 250,000, and let's just hypothetically make it easy and say that entire $250,000 is drawn down immediately. Well, usually, they'll give some sort of prospectus saying, okay, the thought process is we take your $250,000. You're going to get your capital returned in 5 years. And then along the way, you're going to get distributions, and the return that we're targeting is whatever, 10% every year for the next 5 years. Um, the reason they do that is because the markets themselves are very, very illiquid, like I was saying, right? So they can't just go out and sell, um, an entire piece of a deal that they bought, or even small increments of deals, because that's just how the area works. There's not as much liquidity. Um, so that is fantastic. Or excuse me, that's all well and good when things are going well. And I'll say this, that like since they started to balloon back in '07, or excuse me, after the global financial crisis, um, the asset class really hasn't experienced um, a real downturn in credit. Really, when I say downturn in credit, where we had some sort of substantial shock to the system, right? Even 2020 during COVID, I mean, you want to talk about a V-shaped recovery, right? We were down 30% that year, in the first 4 months when COVID happened, and yet the S&P was up, whatever it was, 15%, somewhere around there at the end of the year, which is wild, but still, so I wouldn't even call that a real issue for them, because, right, like it doesn't necessarily matter where things trade or if they do or don't, because you have that lockup period for 5 years on most funds. You know, but where the issue comes in is when investors start to want liquidity before those lockup periods are over, um, which is what we started to see, especially over the last 6 months or 5 months, since the start of this year. So going back to mechanically speaking, the funds themselves have what are called, redemption gates, basically. So, say there's, the funds themselves are a lot larger than this, but just, for example's sake, let's say a fund's $1 million. Well, they'll allow 5% of the total assets of the fund to be redeemed each quarter, basically. That means only $5 million can be drawn down from the fund every quarter. So that would hypothetically mean if one person wants $5 million back, they'll get their $5 million. Okay. Now, say two people want $5 million each. Well, 5 million total can only be drawn down. So they're getting redemptions for 10, but because of what the fund prospectus says, they're only going to pay out 5. So then they go what I believe is a pro rata, whatever the term is, where it becomes a percentage then. So if I want $5 million of my committed assets back that quarter, and then another investor wants 5 million as well, we split the difference. So I get 2.5, they get 2.5, and then we still have total 5 million cumulatively between us still invested, right? 2.5 million each. And they do that because of the structure of the fund and how illiquid things are. And, their thought, what they say is you're paying, a little bit more for what they call illiquidity premium, industry term. When I say you pay more, right, like you're paying a substantial amount more to own these funds than you are public funds, right? Like if you own a mutual fund, the most you're paying is, 1%, maybe a little bit more depending on the strategy, or, as low as, 50 basis points or 0.5%. And this is for mutual funds. Obviously ETFs are different and they're a lot cheaper. But some of these private funds, you're paying upwards of 1-2% up front. And then, sometimes in the back end, it can be 20% as well of profits, just like a hedge fund. They're guaranteeing internal rate of returns of 10% a year or 12%, or whatever it may be. Returns that can definitely exceed what the public markets can give you, and they say like, okay, well, we can quote unquote guarantee this or project this because of this so-called illiquidity premium, which all it is okay, we're going to lock your money up. You can't get it for 5 years, but we're going to give you a little bit more return than you can elsewhere. But you basically can't have your money. which is, again, it's all well and good when things are going well. Okay. No one wants their money when things are going well, right? They look at their statement, things are up, whatever they own is up 10%, 12%, and you're getting your rate of return on that investment, at least on paper you are. What is, what becomes the issue is when people start to redeem their cash, their investments, en masse. And I don't really think the industry's seen that, since they started to balloon, whatever it may be, it was 20 years ago, 18 years ago, but they've started to recently. And going back to why that's an issue, right? Like, let's just say I'm a fund manager. I manage, $100 billion in assets, and um, half of the assets, half of investors come back, and let's just say I don't have the 5% um, redemption gate. Let's just say it's I allow redemptions whenever, and I'll just sell the assets. It might take a little time, but you'll get your money back, right? And let's just say I have redemptions worth 50 billion or half the fund. Um, the problem is that there is very little transparency with the value of the companies that they own because of the illiquidity. At least that's how it used to be. And now I think it's gotten so bad that no one really knows what companies are worth. Um, and I think you're starting to see that behind the scenes. Um, so getting back to the illiquidity and why that becomes a problem is, going back to my example, if you state that you have $100 billion in assets, right? And what I mean by that is I own 10 companies that are worth cumulatively $100 billion, but those companies haven't traded hands in 3 years. You don't really know what that company is worth. You can write down whatever number you want, but until something trades hands, right, you don't know what someone is willing to pay for it, right? And I wrote a white paper on this back actually in January, as soon as I launched the firm. Um, think about it in terms of housing, okay, and what a slow moving process that can be, and really not knowing what the price of your house is worth until you sell it, right? You have a rough idea, right? You go to Zillow, you see his estimate, and my house is worth $1 million. Now, does that mean someone's going to pay $1 million? Maybe, right? It certainly could be, but you don't necessarily know until you find a buyer, and trying to find a buyer, right, can take some time. Over the last couple of years, it really hasn't, especially around here in New Jersey. And we'll touch on real estate at some point in the near future, but case in point is down in certain areas of Florida and Texas, and I think out in Nevada right now, where focus on Florida. There's certain areas of Florida that the real estate's getting obliterated, right? There's certain areas where asking prices have been cut down by 30%. So in that instance, right, you can say, okay, my house is worth $1 million. I'm going to put it on the market for $1 million, but it sits there for a while, and you need to sell it, and then all of a sudden you wind up getting 700,000 for it instead of $1 million. Like, well, that's it. In those terms, right? Could that be a huge problem? Well, if you own the house outright, you don't owe money on it. Okay, whatever. You still get $700,000. You don't get what you think it's worth, but that's what you sell it for. And that now, moving forward, that's what the house is worth, because that's what someone is willing to pay for it, right? Like, that's what the market deems it's worth. Just because someone says it's worth X or $1 million in this example, doesn't mean that it's actually worth that. Case in point, it's worth 700,000. Well, that's how private markets operate. Especially during bad times, which I think we're seeing right now, and we have seen for the last few years. People just don't realize it, and I think it's finally starting to make headlines. But going back to the private equity and private credit in general, and like the illiquidity is, if you have assets on the books, right, that you plan on holding for 5 years, okay? It and you're not going to sell them. You don't really necessarily care what they're worth throughout, right? I mean, you care, especially if they go up, but it's not a concern. Your concern is okay, making sure that you can pay investors along the way over those 5 years, and then have the capital at the end of the 5 years to give back um, to investors. Um, and the interesting thing, to say the least, is how they actually price the assets in between the day that they buy companies, or they start the fund and start to buy companies, to the end of that period, the 5 year period, right? So going back to public equities, um, if you buy a share of Apple today at $100 and you sell it tomorrow for 105, um, that's what it's worth, right? And you know exactly what Apple stock is worth every second of every day while the market's open. You can see it; it's very transparent. Well, going back to what I was saying with the illiquidity, right? The regulate I think regulations state where they have to at least mark their assets to market on a quarterly basis, which is what most do. When I say mark to market, it's it's just okay, how much is this company worth? Um, and then they report that. And some companies have internal teams that price their assets, which do with that what you will, right? So think about that, right? Again, not to sound um, not to sound like I'm bringing up a conspiracy. Yeah, I'm not. This is just my belief. If you, what is the incentive if you have an internal pricing team that you pay to mark your assets accurately if there's significant issues within the asset class, right? There's none. Maybe they'll mark it, like, let's just say in that case, right? The actual worth of the asset is 20% lower than what they're reporting. Maybe they'll correct it 5% or whatever it may be. Um, that's on the internal side, and then other companies pay external companies to mark their assets, also paying them to mark their own assets. I mean, the incentive is right. I mean, it's do with that what you will, basically. Um, so when you mark your assets to market on a quarterly basis, take out the pessimistic view, to say the least, that I have on whether the assets are marked correctly to market. Um, the It's still a huge issue, because even if they are marked accurately, or marked to market accurately, um, you know, you still don't know necessarily what they're worth in between those 3 month periods. So what if I need to sell a company in between there, right? Well, all right, you need to go out to the market. You need to try to sell it. You need to try to find a buyer. And then you find out what the company itself is worth. Um, and it's funny because not, I mean, it's not funny. It's concerning, but private equity, like I said, is roughly like the market, or the market cap, or not market cap, excuse me, the size of the asset class is, like I said, it's, somewhere around 8 to 10 trillion. Private credit is, 2 to 4 trillion. Um, Private equity has what they call a backlog in the asset class, over building up over the last handful of years. And all that means is that there is a substantial amount of companies that are trying to be sold by managers, but don't have buyers on the other side. So they're just sitting there and they need to be sold. But no one is willing to pay the prices that they're asking. And I think the number, most people don't know, like, how large that backlog is. It's 50%. I mean, that is massive, right? Like, you're talking, it's 50% of a $8 to $10 trillion asset class that's basically just sitting there at prices that um, really won't budge, but people need to sell them. Something needs to give at some point. And I think that they floated this and basically kicked the can down the road. And again, we'll get to private credit. Well, you know what? Actually, let's start with private credit. We'll get back to that 50%. And the reason I say that is because private credit has been in headlines for the past handful of months. That's what people seem to be concerned about the most. And I don't think that's the biggest issue. But, I'll get there. You're starting to see stuff unravel a bit in private credit. And the reason being is the exact same as private equity. They operate the exact same way, right? It's marked to market on a quarterly basis, very liquid, yada, yada, yada. So you're able to kick the can down the road as long as you can meet redemptions, and redemptions stay within, a reasonable amount. Maybe you get, a little bit higher of a redemption gate, 1 quarter, but then it kind of fizzles out and then you're under 5%, you're fine. But what happens is that when you get into a situation where the illiquidity premium that you're selling becomes the same thing that could potentially do you in, basically, it becomes a huge problem. And what I mean by that is it's this self-fulfilling doom loop in a sense where, okay, if you have 1 quarter where multiple funds from multiple companies have redemptions of over 5%, and everyone basically, puts up those redemption gates, and let's just say every fund has, somewhere around every fund has a 10% redemption rate for that quarter, and every company only gives back 5%. Well, now headlines start rolling. And XYZ fund from this company, or XYZ fund from this company, or ABC fund from this company, right? All didn't give back capital, all the capital that investors wanted. And once that hits headlines, right, it becomes self-fulfilling, because if I own, if I don't have any concerns over those investments that I own, and all of a sudden I start reading headlines in the journal or wherever I get my market info from, that investors can't get their money back and so many people are trying to get their money back, right, I panic. And it's like, oh boy, I need my money. So again, this self-fulfilling doom loop where now the same thing that helped those returns is the exact same thing that becomes this issue. And I think that's what you've seen with private credit, right? And I think there's a company or two that exceeded, or a couple funds from companies that exceeded the 5% withdrawal limit, or redemption gate earlier this year, and they paid out over. I think one of them was Blackstone, or it might have been like a 7%, and they fully paid it. But then the next quarter, and they think that they're doing the right thing at that point, right, to calm investors' nerves. But then the next quarter they get more, and now they need to put the redemption gate up. And going back to the why that's an issue, right, and where that backlog comes in, and the lack of transparency in pricing, is that now all of a sudden everyone's trying to sell, and the only, I should say this, everyone's trying to gain some sort of liquidity, and you can't kick the can down the road anymore because investors are asking for their money back every quarter. So now this backlog that's been building up, going back to private equity, becomes a huge problem, because now you need to find buyers. So you can't just sit there and say, okay, well, we're going to hold on to these assets. We're going to continue to keep them marked relative to where we think they're marked, or where even the market is saying that they're marked, because nothing trades hands. So going back to the housing analogy, right? Let's just say, there's 20 homes in a neighborhood and 10 of them are on the market, and everyone says their home is worth $1 million, but there are no buyers. And every home just sits there on the market for 3 years at $1 million. People could say, oh, my house is worth $1 million, right? Because it's listed for that. But is it actually, going back to my analogy before? No, it's worth whatever someone's willing to pay for it. And you don't know that until stuff starts to trade hands, right? So what happens when one or two of those people in that analogy say, you know what, I need to sell this? Well, you start to find what's called price discovery. And that, again, an industry term for what is the actual value for this, not what I'm asking. And when that happens all at once, I mean, that's an issue because now you have forced selling in an asset class that already probably has propped up numbers or inflated numbers because nothing trades hands. I think that's what you see going on in private credit right now, where, and I have, I'll give you an example. Um, it was like a year or two ago. Um, I had a wholesaler in my office, and when I say wholesaler, I used to do this. I have a lot of friends in the industry. They're just people who sell you funds or sell you products. I had a pretty knowledgeable wholesaler in my office talking, and he was from a private equity firm. He was talking to me about his fund. And actually, no, I'm sorry, it was a private credit fund. And this is back, actually, I think this is back in 2024. And, I brought up my concerns, and my concerns really stemmed from 2022, where I didn't really understand how an asset class could only be down 4%. I think that's private equity. Private credit was down less. Could only be down that when there was no place to hide that year. Like, again, bonds, the safest thing that you can hypothetically buy, right? Like that's, some bonds were down 40%, like AAA bonds. There's no concern about them defaulting, right? So I was, we were discussing, and I brought up my concerns about, whether certain assets or the entire industry are marking assets correctly to market. And, it's funny because when he answered the question, I believe he was, trying to say that the firm is very transparent. And I would agree with that. But like what he said just solidified my concerns, which was his company and then two other companies went to buy the exact same piece of a deal. And he said that, his company, bought the piece of the bond or piece of the company, and they marked it at 70 cents in the dollar. Right? When I say 70 cents in the dollar, let's just say the actual bond, once it matures, is worth $1,000. Well, they bought it for $700, which happens all the time, right? They're buying it at a discount. Fantastic. The concern comes when he told me that the other two companies who bought the exact same investment, same thing, same day, same time, at par, meaning that they marked it on their books at $1,000. And for me, it's like, okay, now, for me, that's not an isolate. Like even it's just one example. There's no way that three asset managers buy the exact same investment on the same day, same time, and two mark it at par, and one company marks it 30% less. It's a massive issue, right? Because someone's right. And I'm going to take the firm that he works for, right? That it's worth 70 cents on the dollar. I mean, that's just my opinion. I mean, maybe the other two were right. Who knows? But like, that's the lack of transparency, I think, that people don't understand, right? And that has been going on for years. And for me, that one instance kind of solidified all the concerns that I had, years prior. And they've been able to kick the can down the road for years now, even since then, last handful of years, because redemptions have been subdued. And they've been able to somewhat bring in more capital. but also, and here's another concern too, where when the asset class first really started to to gain traction after 08, 09, just like any asset class that's small, right? They focus on institutions, pension funds, endowments, um, large private investors, and you kind of get why, right? Because if you can sell a product to one investor and get $5 billion, or you sell, to 100 different or 200 different investors for the exact same amount, right? Like, it's much easier just to sell to one. But what happens is, over the years, they've opened um, they've opened the gates, if you will, to more and more investors. And what that does is it brings minimums down, because there's only so much capital in institutions that they can, that they can grab, basically. Um, so they need to go out and find more capital. And how do you find more capital? Well, you open it up to investors that don't have as much money, right? So then it's, instead of endowments and pension funds, and you go to high net worth investors, right? People who have $50 million, $100 million, $25 million, right? That don't necessarily need the capital at all times, right? And then once that pool of money, or that liquidity pool, dries up and there's not as much capital to be to be generated from there, then you lower minimums. Maybe people with $1 million or 5 million, right? And they do that in terms of minimum investments, meaning, okay, you need to commit $250,000 in order to invest in this fund. And I think that's what it was. Maybe, I don't know, 5 years ago, maybe more. Most funds had like a $250,000 minimum or so. Well, it got as low, like, the last couple, like last year, to 25,000, and now today I've seen minimums as low as 10,000. Run. When you see that, right? Because the lower the minimums get, especially in an asset class that's so illiquid like that, and going back to my initial, um, my initial comments before, where it's easier for them to deal with institutions and endowments, because it's easier to get one deal for 5 billion, as opposed to now focusing on so many. If people want to invest with $10,000, that just screams, okay, we're running out of capital, or people to invest capital. So once that the music stops, if you will, from investors, meaning like, okay, there's no more capital, no one's really investing that much, and then you get hit with redemptions, and on top of that, you have marks on your book, meaning that, okay, you have companies valued at numbers that are way higher than what they're worth. I mean, it's a recipe for disaster. And that is 1,000% what I believe has been going on, and what we're starting to see right now, where you're going to see what some of these assets are actually worth, because the redemptions won't stop, right? They're just, if you have no real capital to pull from, because now it's just, not only did they not really have much capital to pull from, because they're lowering investments and they're looking for, more retail focused investors. Not only do you do that, but now now even the people that have investments are looking to redeem, and you have these negative headlines. So even if you did have a pool of capital to pull from, or new people to try to sell this product to, which they've tried, right? I don't know if you saw in headlines over the last handful of months or last year, where the government or whoever it was thinking about allowing them to open up private investments to 401ks, is because they're looking for liquidity. And when let's just say you do find another pool of liquidity, and they were to open it up to 401k investors, well, the headline's already doing damage for anyone who's paying attention. So if you even find some subset of investors that still want to put capital into the markets or into private markets, um, they're reading the same headlines that investors in the funds are reading. Why would you want to put money into a fund that just has negative, or excuse me, into an asset class that just has constant negative headlines? Um, so when you have massive redemptions down coming on a quarterly basis, and you have no new funds coming in, well, yeah, that's a problem. Um, and also, too, you want to talk about illiquidity. Well, if everyone's in the same boat and no one wants to sell, or there's no one to sell to, what do you do? I mean, I think again that's what we're seeing play out. And really, what's going on behind the scenes is, I wouldn't even get into it. Um, it's way worse than I think most people realize. Where like they need liquidity, so basically, what they'll do is, um, some companies, or a majority of companies will have, oh god, I forget the name. They'll basically have subset funds where they'll basically sell them to themselves and have a separate vehicle and bring liquidity in from a separate part of the firm. Or some of these private companies own insurance companies. Okay. So they'll basically take an investment from one fund, sell it to the insurance company that they already own. There's a liquidity. It's just cash sorting at the end of the day. Um, and that that only lasts so long, right? And and also too, right? The entire industry is in the same boat. You see, there's a handful of major players in the space. Blackstone's the largest. You have Apollo, Arez, um, KKR, Blue Owl's pretty big, and yeah, they dominate the market. So if everyone's going through the same thing and everyone's looking to sell, again, there's no buyers. What do you like? What do you do? Um, and I think I think the market is woke has started to realize that. I mean, you look at stock prices of these companies, the ones that I just named. I mean, they've cratered, and get it's funny because, and I'm going to get into this, in episodes down the road of an area that I really think is is where you want to be long term, is tokenization. And tokenization sits within cryptocurrency, right? And crypto has such a, you know is such a dirty word in the industry. Oh my goodness, it's so volatile, you can't own it. um and then you look at crypto today, and it's gotten annihilated. Let's just talk about Bitcoin. I mean, I don't necessarily like Bitcoin. um I don't really at all, because I do agree with most people that it doesn't really have much utility. But the technology that it created decades ago is going to revolutionize finance, and I'll get into that. And it's really surrounded by tokenization of assets. But um, people want to talk about how volatile crypto is, and Bitcoin is down 50%. Go look at the stock prices of Blackstone, Apollo, Arez, KKR. I mean, Blue Owl's annihilated. They're down just as much, if not more. Bitcoin's down 50%. I think Blackstone's down 40. Blue Owl is down over 60. Pretty much the entire, all the five major players are down somewhere between, 40 to 60% from their highs. So, volatility exists anywhere. And I think that's the market really starting, it has started to wake up to this idea of like, holy crap, this is a real problem. And is it an issue that's only, you know, only, segmented in a certain, a certain sector within private equity or private credit? I think the headlines are software and BDCs or whatever it may be. And the truth is that, no, it's an entire asset class problem because that's exactly what's been going on in the asset class, right? Um, and I think the truth is that no one really knows what these companies are worth. The the way that the private markets work is it's very archaic in nature. Um, a lot of stuff is done manually. It's very slow moving, which again goes back to like why it is so illiquid. And it's um it just, again, it's a massive problem. And going back to the stock prices, right? It's like it'd be one thing if one company is down 40% and the others are, flat or whatever it may be. No, it's an entire asset class problem because every stock is down 40 to 60%, every one. Um, and getting back to the private credit versus private equity thing, right? You see you see a lot of headlines about private credit and how, the issues there. You don't really read much about private equity, and the truth is that private equity is a much larger deal than private credit will ever be, for two reasons, right? One of which is private equity is 4 times the size of private credit in terms of in terms of assets within each asset class. But also just understanding the capital structure of any company, right? So what I mean by capital structure is if a company were to go belly up or go bankrupt, right? Any remaining assets that the company has on the books, bondholders get paid out first. They sit atop the capital structure. So if a company goes belly up and there's only enough to pay 50% of bondholders, and they call that a recovery rate. So meaning that I invested $1,000 and I'm a bondholder, I get 500 back. Anybody else below bondholders are wiped out, zero, and equities last in the capital structure. So that means if bondholders aren't getting all of their money back, equity gets zero. So if there is an issue, a large issue that's not just within one little area of private credit, but it's a much larger issue, which I 1000% believe. And again, you can see equity markets are starting to realize that as well because their stock prices are down, 40 to 60%. Then private equity is a much larger issue because now not only is the asset class 4 times larger than private credit, but if you have an issue where you think bondholders might not get paid back in some of these companies, I mean, private equity, that's a much larger deal, and I don't think many people are talking about that at all, which I don't really understand. Because that, again, those two reasons, much larger and last in the capital structure. Again, the markets understand that. I keep on going back to, you can see it in equity prices. And actually, there's been headlines where the government is starting to not step in, but they're starting to ask questions with these companies, right? And that's where you're like, okay, this could be bigger than what we think if the government is starting to ask questions. And I think where this idea of systemic becomes an issue, not as if what I think is going on is actually going on, right? Obviously, that's a huge issue just for the markets in general, right? You have a $14 trillion asset class that has these issues. I mean, it doesn't matter how far it expands beyond these companies. because that's just a huge issue. But it could be a lot. Um, Hypothetically, it could be a little worse than even that. And I'm not a doom and gloom person, by the way, right? Like I hate looking at things from a negative perspective, but when you're investing people's money, right? Like, and this is just my opinion, and I'll get into like my investment thesis and the firm's investment thesis in another episode. But you need to start at negatives always. That's just my opinion. You need to see where, um, where companies or funds are basically poke holes in them and see where their issues might be, and see if you can live with those issues. And that's just what I think. And again, I'm just so hyper focused on private markets because I think it's by far the largest issue in markets right now. Um, it could expand a little bit more because it's not just that, okay, now investors want their money back and they need to find buyers, and the assets are marked way too high than where they are. Um, these companies also have exposure to banks as well via loans and lines of credit that they take out, that they use these assets as collateral sometimes, right? So now you get into what's called counterparty risk, where, okay, now the risk itself isn't just siloed within one company. It's, okay, I have, collateral that I post for $100 million I'm making up a bank, excuse me. I'm just going to use Bank of America, for example. I don't know what I'm not saying that they're an issue at all. I'm not saying any bank is an issue. But let's just use Bank of America, for example. And I have $100 million of assets that I have, or assets, I should say, that on paper I have marked at $100 million. And I want to borrow against that. And that happens all the time. And I go and Bank of America extends a line of credit to me at whatever it might be, 70 cents, 80, excuse me, 70%, 80% LTV. When I say LTV, like loan to value. So I'll give you a line of credit on 80% of what the asset's worth. Well, if they're saying that the asset's worth 100 million, but maybe the asset is only worth 50 million, and they borrowed 80% against that 100 million, well, now that becomes a problem for banks, right? Which also, and this is probably well, not probably, right? Like a conspiracy, and it's not even a conspiracy; it's just logical. Um, Another reason why keeping asset prices elevated, on top of all the other incentives they have to do that, um, is, okay, if I, on top of needing investors' money, or meeting investor redemptions, I should say, I have loans against some of these companies that, I say are worth 100 million, but they're only worth 50. Now it's like, okay, it's you have much more risk than you think. Um, and I promise you that's going on as well. And my guess is that that's maybe why the government got involved, or maybe banks don't even know the exposure they have. And you've seen headlines recently. I forget who it was recently, if it was HSBC. But basically there was a large private company that went belly up, and a large bank took a huge hit, billions of dollars. I think it was HSBC, but I could be wrong. And they had no idea they had exposure to it. None. Because of the change of hands also in collateral behind the scenes, right? So if I'm Bank of America and I extend this credit line to this private equity company, let's just say Blackstone, for just to use this example, I'm Bank of America, I loan $80 million to Blackstone, and I hold that loan on my books. If I'm Bank of America, well, I could trade that loan to another bank for, again, I think it was HSBC. I could be wrong, but let's just say it's HSBC, and now HSBC takes on a loan, or it takes on that loan or a piece of that loan, and they don't really know what they took on. Um, Now it becomes a much larger issue. Um, and in my opinion, there's no doubt that that's going on. It's just a question of if it's significant enough where it becomes, a systemic issue. Um, and I don't know. I hope it does not. And again, I hate to be so doom and gloom. Um, markets long term, 5, 10, 20 years from now, they'll be higher than where they are today. That's not an issue. But in the next, whenever, 6 months, 12 months, couple years, whatever it may be, like this, something needs to happen here. Um, because redemptions aren't going to stop. You have no buyers really for these assets if you still have 50% of the entire private equity asset class that needs to be sold and no buyers at the prices. um, Something needs to give. You can only kick the can down the road so many times. um, and again, that's the many reasons why I think it is by far the largest issue within financial markets right now. you know um, we'll see what happens. Obviously, maybe redemptions slow down and they find another pool of capital. That that could happen, where headlines um, start to dissipate. People become less concerned. Maybe there's some good headlines that come out where they start to have massive investors come back in or whatever it may be. That could absolutely happen, right? And maybe it gives them a lot more time to have these companies come back to the values that they're stating. um Again, that's an ethical thing. But maybe that's a possibility. I just don't know where that capital comes from. We already said that investment minimums have come down to $10,000. It's like, where does that capital come from? Um, and I'll touch on this point one more time, going back to how it's been sold to investors and why probably, however it plays out, why regulations are definitely probably coming down the pipeline is because it has been sold as this asset class that you need in your portfolios because it's not correlated to equity or public equity and bond markets. And going back to where my concerns really started in 2022, and I wrote this towards the end of the white paper, and I left it open for, left it as an open-ended question. But I think, given given what I've said throughout this conversation, you know where my thoughts sit. Going back to 2022, is it likely that every single investable market throughout the world was pretty much down somewhere between 20 to 10 to 20%, and that 10% being bond markets, public bond markets, its worst year in history, and private credit or private bonds and private equity are both down less than 4%? Or is it more likely that they can just basically make up whatever numbers they want on paper, and it doesn't really matter until it does? Meaning redemptions come in, they have no new capital coming in. Is it really not correlated? Or is it just, again, they can kind of do what they want when it comes to marking assets to market? And again, I think that we're going to see what happens with the asset class, because this is really their first, their their first real test. And I hope they figure it out. At some point things need to start trading hands. However, right? Because if not, think about the other side. It's like, okay, if people just continue to have redemptions, you don't have new capital, you don't have buyers. One of two things has to happen: either you completely shut down redemptions, which they can't. I mean, well, I don't know. I don't read the legal documents that they have. Maybe they have that lever to pull. Or buyers need to start coming in and price this stuff accurately, right? And so I will say this: here's a an example of new capital, and I'm not talking about investing, I'm talking about purchasing the companies themselves. I think it was Jamie Dimon came out within the last year or so, and JP Morgan started um, their own private credit arm in terms of investments. Genius, because he sees it, right? And I will say this: there's definitely companies that, um, maybe even a majority of companies in the space that are still worth, um, a good amount of money. Just because there are these issues and there are these issues in the entire space doesn't mean that every single company in the space is worthless, right? No, there's so many that they're probably going to be fantastic deals on behind the scenes, or maybe there are right now, and people, smart people like Jamie Dimon, who might not have had a real footprint there from an investment standpoint, right? That's when you start to load up the coffers, if you will, in terms of investments, right? You basically wait for those dominoes to start dropping, and maybe you can get some fantastic deals. And that's, in my opinion, probably what will happen. Um, and that's where like the real price discovery, as the industry calls it, comes in. Where, okay, now you really need to start finding buyers, and buyers come from places like J.P. Morgan, but there's no leverage there, right? That the leverage is all on JP Morgan's side in that instance, right? And there'll be more buyers as well, because they're the only buyers in the market. And then again, you start to see what these assets are actually worth. Going back to that, that housing example, like I said, you have 10 houses in a neighborhood, or what I said, maybe I said 20, but let's just say 10 house neighborhood. Everyone says that their house is worth $1 million, and no one sells for 3 years, but then two people actually sell for 700,000 or 500,000. The other 8 people that haven't sold, I don't care if you think your house is worth $1 million. Now it's worth 500,000, and now it's all bets are off. So, um, we'll see. As I say, we'll maybe next one we'll get a little bit more optimistic on certain things, right? Again, I don't mean to be so doom and gloom on certain stuff. I think the last episode I did was more so on inflation and Iran and, what could potentially happen with oil prices, but like I said, at the end of the day, if you're managing people's money, you need to start, um, from an investment standpoint with where the risks lie, and can you live with those risks? And, and that's just kind of how I view things. Like I said, little teaser, I do believe long term that this idea of tokenization of assets, within, I won't say crypto because it's such an ugly word in the industry. Within blockchain is, in my opinion, probably the largest opportunity over the next 5 to 10 years from an investment standpoint. I think it's going to completely change the entire landscape of the financial markets. I don't think the financial markets have seen this type of revolution that we will see, since um, since markets went um, to computer, or since they computerized markets. I think they started back in the 70s or 80s with that, and pretty much wiped out the floor of the stock exchange. Now it's just basically a museum, if you will. I think that's coming down the pipeline, and you're already seeing that. You can see Larry Fink, Jamie Dimon, all these people have come out and they're coming around to the idea that that is the future, and hundreds upon hundreds of billions of dollars are already using blockchain and instantaneous settlement. But we'll get to that at some point. And yeah, like I said, I continue to say we're going to have some guests on, some in the industry, some small business owners, and hopefully some of this stuff is impactful. And if you have any other questions, again, you want to talk about it in more detail, if your assets are somewhere where you're not happy, you're looking to make a change, or uh, you're open to a conversation, give me a shout, as I always end these with. My website is bridalwoodprivatewealth.com. My phone number is on the website. And you can also shoot me an email, or shoot the firm an email at info@bridalwoodprivatewealth.com. And, I'll see you guys next time.